So this has been a long delayed forecast for 2020, but this is the Traderfirstyear 2020 outlook. Topics covered will include Federal Reserve policy, GDP, S&P 500, Treasury Yields, US dollar, oil, and realized volatility. I continue to reiterate deceleration in first half and second half of GDP and potential for a V Shaped recession in 2020. Demand destruction in US domestic economic rebalancing. The adjustment process in Global Current Account Imbalances has begun. The adjustment process in the U.S. domestic economy is underway. However, U.S. consumers will continue to shoulder a substantial amount of global current account imbalances, which will lead to a prolonged period of U.S. dollar strength through the course of 2020. U.S. consumers during the slowdown continue to act as a global engine of growth due to higher real wages, relatively faster growing economy, strength in the U.S. dollar, and etc. And so the real GDP case for 2020 full year is between 1.25% to 1.6%. Still working out the numbers. Some of that's going to be driven by consumption growth is expected to slow below trend, which is about 1.8% to 1.2%. It's going to be contributed by weakness in service growth, will be a material driver of GDP downside risk. 2, investment growth will continue to subtract, driven by material weakness in non-residential fixed investment. 3, residential investment will continue to surprise to the upside, driven by rate cuts, the tight labor market, growth in millennial household formation, and stable income growth. However, small size of GDP limits the upside impact on overturning material slowdown in structures. It's a very small component of GDP, about 3% of overall GDP in terms of residential investment. 4, government consumption growth expected to slow below trend at the federal, state, and local level. Recent continuing resolution provides a small amount of fiscal stimulus at the federal level, but nothing near the 2017 tax cuts. In terms of net exports, which is the 5th, that's expected to slow. Slowing growth in exports is reflecting very slow potential growth rates of the U.S.'s largest trading partners and the overall slowing of the world economy. And imports are reflecting a gradually weaker U.S. consumer. So you've seen both of those actually contract over the course of the end of the second half of 2019, and that's likely to persist through the first half of 2020. In terms of Fed policy base case for 2020, I see 3 rate cuts totaling about 100 basis points versus consensus estimates of a tepid 1 rate cut throughout the course of the year, which is technically was initially positioned at about December, has moved up to about January. Where I see it differing, and I have a substantial difference with current consensus. So March 17th, 18th meeting, I see about a 25 basis point cut. And then again in the June meeting, I see another 25 basis point cut. And then at the where I'm coming into some issues is the September or December meeting. And I think if they were to cut in September, or if they're going to cut in December, it's going to be a 50 basis point cut, which brings me to the total of 100 basis point cuts. So it's either going to be a 50 basis point cut in September, or it's going to be a 50 basis point cut in December. The interest rate base case for 2020, again, I see 3 cuts in 2020 at most, leaving the federal funds rate at 0.5 to 0.75, so about three quarters of a basis point to end the year in 2020. The 10-year Treasury is going to trade at about 1%. Possibly at the end of 2020 year end versus the consensus estimate, which is currently at about 1.8%. So again, a substantial divergence between where I think it's going to be and where the market currently thinks it's going to be. Number 3 is the portfolio capital inflows from abroad in the first half of 2020 and structural issues, e.g. technology, productivity, demographics, will continue to compress the term premium and act as an anchor on 10-year and 30-year yields. There is some risk once portfolio capital inflows reverse in the second half of 2020. Again, a lot of people have been calling for that. No one's necessarily sure when that's going to actually take place and when that's going to happen. 4, position for UST curve steepening temporarily into the cuts, but flattening and inverting closer to year end. 5, the Fed balance sheet expansion will halt after April 2020 meeting and will become a material driver of realized volatility in the near term. And so the exciting stuff now. So the S&P 500 base case for 2020, the current price as of this morning, which is 2/24/2020, and it's about 9:30, was 3,295. I have 2020 EPS at about 168 per share. 2020 EPS growth between 3.5% to 4%. I have 2020 dividend yield between 2% and 2.1%. So the earnings yield, given those numbers, is about 5%. When you do the inflation adjusted, that knocks it down to about 3%. The S&P 500 return, based on those forecasts, is between 5.5% to 6.1%. So the overall numbers are going to be S&P 500 forecast price range. At the low end, I have about 2,700 to the high end, which is going to be about 3,400. So the ending target price for the S&P 500 at the end of the year in 2020, I see it about 2,950. So the inflation base case for 2020, I reiterate for an unanchoring of inflation expectations due to low inflation and possibly a fall in prices. One, consumers may start to delay purchases, waiting for lower prices in the future. Two, firms may reduce investment, preferring to wait for lower rates. Three, this could result in a reduction in consumption or aggregate demand throughout the year. And then four, debt-driven liabilities, loans, credit cards, and credit cards and an increase in debt burden on borrowers, typically if you have a fall in inflation expectations. So then the final thing for the full year, so I want to reiterate some of the major risk to all the trades listed below is possible destabilization in global geopolitics, i.e. war. Seems like a huge risk, which would be more positive for bond yields falling further and commodity prices moving higher. So these are the forecasts as of right now for the 2020 outlook. Thanks for listening. I'll actually have these all individually broken down into individual videos similar to last year's forecast and presentation. So thanks again for listening and for following.